Good morning. Welcome to Crypto Radio. Good morning and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. Today we have all the fun stuff. 2 new miner releases, mining software releases. We have Amd Ryzen 7000 series launching on the same day as the Intel 13000 series. And we have a few different things happening within crypto. One being that Monero has completed its hard fork over the weekend. And we have all the details on what that update and upgrade includes. I'm pretty excited about that because obviously you guys know I'm a pretty big fan of Monero. Then we have, of course, more talk about forking ETH. I know. We already have a fork of ETH. It's called Ethereum Classic, but we got to cover it. We got to see what's going on. I still don't think that necessarily it's a good idea to go out and purchase, a coin that doesn't actually have a chain to record any of the transactions on, but we'll get into all that. We also have a very interesting article that is titled The Definitive Guide of Proof of Stake to Proof of Work, not for miners, but for investors. For miners, we know what that means, right? We can no longer mine. So as far as using our form of investment, which is silicon, into, of course, a proof of stake coin, for the most part, isn't going to work, except for one thing that we have coming up this week, which will be ZK proofs, and we'll be talking about that sometime around the 18th or 19th. I know the interview's on the 18th. Hopefully, I'll get it out same day, but we'll have to see from there. Lots of stuff coming to the channel. I am just kind of falling behind with the amount of work that needs to be done. I'm not going to lie. That's what's going on. I kind of have a little bit of ADHD in the farm right now where I'm like, oh, I'll go work on this. And then I'm like, I'll go work on this. And then I'm working on that. And then I'm working on this. And then I run into issues and I'm not getting it done. I need to start picking pieces out and just saying, okay, today I'm going to do this. I'm going to make a video on it and we're going to get that video out. So that is kind of my goal. Huge news as well. The second channel, the Blind Run channel, was monetized and I applied over the weekend and it actually got approved this morning. So we have a second set of revenue possibilities over on the Blind Run channel. Not quite sure yet what we're going to do with it, but there is basically that over there. Right now it's just vlogs and clips from Twitch. It's kind of fun, a little bit more personal. So there you go. I want to thank everybody that helped get that channel monetized over there. So let's get into all of that, all of the news articles and more right after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. Welcome back, ladies and gentlemen, boys and girls, crypto miners of the world. First things first, we have a new beta release from BZ Miner. This is version 10.0.3b2 beta. And what's in this release specifically? More improvements to the ETH/ETC, so Ethereum, Ethereum Classic, plus Caspa hash rate for NVIDIA GPUs. They also improved ETH plus ETC, ETH and Ethereum Classic plus CAS auto tune, and they added max dual auto tune drop option to control how much ETH hash rate you're willing to lose when auto tuning. The default is 0.92. So basically, if you want to try to maintain 100% of your Ethereum hash rate, you could set that to like 1, all right? And that would be 100%. or you can tune that down so you get a little more power on the Caspa. I'm also working on a guide for Caspa, specifically with you guys that have a node already built. I don't know about you, but my Caspa node has incredibly good latency. It runs really, really well. And so I'm probably going to be trying to get this set up at least in a form where it's ready to go once the temperatures begin to come down. Because right now, dual mining hasn't been something I'm very capable of with my current temperatures. They also added a disable Opencl option, useful for rigs where BZ miner crashes due to AMD drivers. And they fixed Opencl enumerating device 00. We also have another miner release from T-Rex miner of all people. It's been a while, T-Rex. And unfortunately, I just don't think they're catching up with, the big boys. We got LOL miner getting the dual mining out, right? We got BZ miner getting the dual miners out. We got all of this stuff going on. And T-Rex is kind of still just sitting back. They have a very small release here. They say they make the light hash rate unlocker compatible with older drivers, which is good. It still has to be 470 and above, but that's a good improvement. I just feel like they're falling a little bit behind. Now, a bug fix for ETH hash for Ethereum, which it's like, yes, obviously a bug fix is good, but for Ethereum, coming up to the merge is like, okay, get us some good setups. Get us something unlocked that's running really fast on one of these other coins, But this bug fix is miner allocates excessive amount of GPU memory, which causes 6 GB cards to stop mining on Windows earlier than expected. A pretty, honestly, I don't even care about that bug. I don't know how many people are using Windows to mine, much less Windows on a 6 GB card, and probably already switched over to LOL miner if they're having issues on T-Rex. T-Rex has some catching up to do. That's all I feel like, okay? I feel like they got some catching up to do to get us up and running and prepared for the merge. I think all the mining software does, but there are some mining softwares that are standing out. LOL kind of number one, right? Even to the point to where they built basically a proxy that you can load, or Stratum, that you can load directly into Hive OS so you can solo mine Caspa. That's how much innovation LOL miner's working on, while T-Rex is just kind of falling behind on the wayside here. I know I'm kind of hammering on them, but it's when you got something like T-Rex miner that's been such a staple in the mining community for NVIDIA GPUs. Come on, guys. We know you can do it. Catch up. That's all I'm saying, right? That's all we want. AMD moves Ryzen 7000 Zen 4 CPU launch to the 27th of September. So that will be the same day as Intel's 13th gen Raptor Lake unveil. AMD seems to have moved its original 15th of September launch plans for the Ryzen 7000 Zen 4 CPUs and the AM5 platform to late September. We have just got confirmation from our sources that AMD will be releasing its next gen CPUs in late September for sales. Earlier this month, we reported that AMD was going to host an event in late August where they will announce all the details, such as specs and prices for their next-gen Ryzen 7000 Zen 4 CPUs and the respective AM5 platform. The company had also planned to open sales just 2 weeks later on the 15th of September, but it looks like AMD has decided to halt the sales a bit and position the real launch next to Intel's 13th gen Raptor Lake CPU on the 27th of September. Intel is expected to host its innovation event on the 27th of September, where the company will unveil its latest desktop processors codenamed Raptor Lake. The CPUs won't be unveiled until October, however. AMD's Ryzen 7000 CPUs will be ready for the mass consumer market. This may seem like AMD being very confident to launch their chips right when their competitor announces their next-gen parts. At the same time, online retailers have started listing down several AMD Ryzen 7000 CPUs along with preliminary prices. So you got the 7950X, the 7900X, the 7700X, and the 7600X. AMD's first wave of 600 series motherboards would focus on the higher end X670E and X670 designs, followed by the B5 or 650 and the B650 or E products a few weeks later, around October or November. The new CPUs will feature a brand new Zen 4 core architecture, which is expected to deliver up to 8% IPC, greater than 15% single-threaded performance improvement, and a greater than 35% multi-threaded performance improvement over the Zen 3 cores. Additionally, AMD is going bonkers with the clock speeds on their next-gen CPUs with up to 5.7 gigahertz boost clocks, and that's at 170 TDPs and 230 watt PT. Plus, the platform will be outfitted with the latest technology such as Gen 5 for PCIe, Gen 5 support for M.2. I would hope so if you got the PCIe Gen 5. I mean, those go hand in hand. And DDR5 memory support, which Intel has had pretty much all of those already. For example, I already got, DDR5 in my current system. I already got a Gen 5 M.2 in the current system that we're streaming to you guys from, and I already have PCIe Gen 5. And so the only performance improvements that I've gotten really out of that, though, is the M.2. To be fair, right now the DDR5 doesn't show a lot of performance improvement on the Intel side of things yet. But as we know, with, the architecture of the AMD CPUs, you'll probably see a significant boost from DDR4 to DDR5 just because of the way it's structured. As a new SAS Smart Access Storage firmware suite that adds or that runs on the Direct Storage API framework. So you can get up to 16 cores. That's the rundown. You get over 15% performance uplift in single-threaded apps, which is going to be important. Of course, we do know that we are looking at possibly up to 6 gigahertz and beyond on Intel without any sort of LN2. So we are talking about probably liquid cooling on the Intel Raptor Lake, right? But we're talking about over 6 gigahertz on the overclocks. Now, this is important because this is kind of history repeating itself with AMD versus NVIDIA as far as the past few generations. And AMD has been in a position where they're very good at getting every single hertz out of the CPU as possible. This means, though, that when end users get these CPUs, they don't have that overclocking headroom. So when AMD says, 5.7 gigahertz, it's probably going to be 5.7 gigahertz. It's not going to go beyond that more than likely, or at least not by much. Whereas on the Intel side, especially if you do things like turn off the efficiency cores and so on, you have that potential for turning up that overclock more and more and more and more, which means you get better single-threaded app performance. And yes, it's 2022. We have a lot of multi-threaded performance applications, which is getting there. But for the day-to-day use, that single-threaded performance does make applications a lot snappier, especially things like browsing and so on, or even just extracting files. But where AMD will set itself apart from the mining perspective, as always, and can be expected here, is going to be the mining specs, right? Where we will have, as far as I can tell, probably a pretty nice boost in mining performance on the Zen architecture, because we are getting things like more cache. We are getting better performance overall per watt. These are things that are going to be extremely important when we get into mining. That being said, a lot of the CPU mining is not that profitable, right? So this isn't something you're going to look at and say, oh, yes, new architecture from AMD. I'm finally going to get like a nice little boost in, farm profitability and revenue. Unless something really comes into fruition from the CPU mining side, that won't be the case, right? There's some outliers that are still kind of trying to be profitable, anything like Raptorium or even Darrow, but they really don't have that mainstream support. The only CPU mineable coin that really has that mainstream support is going to be Monero, but as you guys know, the margins are extremely low on Monero. So is the mining community going to help shore up the sales of the 7000 series versus the 13,000 series from Intel? Not necessarily, right? Let's go ahead, though, and get into crypto mining news. Crypto mining hosting firm Applied Blockchain adds a $15 million loan to pay off debt and fund growth. The company's North Dakota site was knocked offline in July due to an equipment failure in the substation feeding its power. Bitcoin mining hosting company Applied Blockchain has secured a $15 million loan to pay off its existing debt and fund the build-out of data centers. The loan, which was granted by North Dakota Bank, is expected to have an interest rate of 1.5% for the first 13 months after including state-based economic incentives and 6.5% for the remainder of the term, according to a company's press release on Friday. Debt has been sore spot for some crypto miners, some of which have faced margin calls on their loans as the value of their collateral, usually Bitcoin or equipment, has diminished during the past few months' market rout. Given the capital-heavy nature of the mining business, however, raising funds through debt has been one of the few ways miners have been able to build during the bear market. Quote, the new credit facility doubles our loan to value on our Jamestown facility and provides us with additional capital to fund our growth plans and deliver on increasing demand for our customers, said CEO Wes Cummings, said in a press release. Hosting is a service that data centers provide to crypto miners so that customers can store their mining rigs and mine their preferred digital assets for a fee without having to build the accompanying infrastructure themselves. In recent months, demand for hosting crypto miners has seen an uptick as infrastructure and power supply related delays, as well as lack of capital, have caused bottlenecks for miners that are often now finding themselves with more mining rigs than available power. In March, the company signed a $7.5 million 5-year loan with Vantage Bank Texas with a 5% interest to build the site in Jamestown, North Dakota. The hosting firm has 100 megawatts worth of Bitcoin mining capacity at its Jamestown facility, which has been partially offline due to unexpected equipment failure at the substation powering the facility, but which was expected to be back up and running early in September, according to a July 18th press release. The company didn't immediately respond to requests for comment on any progress on the facility. Hosting is a service that data centers provide to crypto miners so that customers can store their mining rigs and mine their preferred digital assets. We already read that. They posted that twice. Most recently, Applied Blockchain has signed a deal to host 200 megawatts of Marathon Digital Holdings mining rigs in the North Dakota and Texas facilities. Applied will supply Marathon with 90 megawatts of hosting capacity at its Texas location and at least 110 megawatts at a second facility in North Dakota. Shares of Applied Blockchain were down 3% on Friday morning, while Bitcoin price was slightly down. And we're a little in the red today, but it's really still looking very, very impressive for a bear market, meaning we're way over my projected kind of sitting, right? So usually, like we've talked about before, during this time, I was expecting anywhere between 18K and 22K on Bitcoin, and we're at 24K. And on Ethereum, well, this is an expected pump because all of the news surrounding the merge and the success of the Goerli testnet. But overall, miners are, looking for capital, trying to survive the bear market, and a lot of them didn't get into a strong cash position. So, once again, they still seem to follow the price of Bitcoin as far as if they're a publicly traded company. And all you really do if you invest into a mining company is end up putting yourself in a position where you have additional points of failure, meaning more risk in general. That being said, there is the potential for investing in some of these who have gotten themselves into a good cash position during the bull run to kind of be a little better off. So I guess there is some upside there. Examples of some companies like that would be Hut 8, who has apparently done pretty well this bear market comparatively. Now, congratulations to Monero. They had a successful network upgrade. And so Monero is now more private and efficient with ring size 16, bulletproof plus, and view tags, making sure your node wallet is up to date to continue using Monero. Privacy and fungibility matter, and it's exciting to keep improving. What is in this upgrade? So this was on Saturday. The number of signers for a ring signature will increase from 11 to 16 for transactions. Bulletproofs Plus, an upgrade to the current Bulletproofs algorithm, will be introduced. Bulletproofs Plus reduce transaction size and increase transaction speed. Overall performance is expected to improve by 5 to 7%. View tags will be a new way to speed up wallet syncing by 30 to 40%, which is pretty incredible. And fee changes will minimize fee volatility and improve overall network security. Along with multi-signature functionality will be improved and critical security patches will be added. Now, you guys know we were talking about the profitability of Monero not being that great. There's new fee structures, so on going on here. We're going to get into more details later in a video, and it is maybe time to look at, what are you guys doing on Monero? Also, we have P2 pools, which are extremely important for decentralization. So digging in and learning right now in the bear market is the best thing you can do. And starting out with a privacy crypto that basically has the first implemented P2 pool available would be something that I would highly encourage right now. Overall, super bullish on Monero. Obviously not financial advice, but personally bullish on Monero as we get into the rest of all of this craziness in macroeconomics and so on. Of course, with the privacy, the amount of decentralization, and its solid network with frequent upgrades, it's pretty awesome. Now, there is a dude named Chandler Go, and he is reiterating his support for the Ethereum fork post-merge. Now, obviously, we have the merge coming up in about 30 days at the earliest now, right? It's between 15th and 16th, the latest, the 20th. That's what we're being told. We have a total terminal difficulty set, meaning that this can be measured and that can be adjusted depending on the amount of hash rate on Ethereum. It doesn't look like the hash rate on Ethereum is going down by any means, by the way, either, meaning what are we going to see from the mining perspective from the merge? We don't know. We can't determine that because there seems to be no sort of shaking of hash rate off of the Ethereum network, even though we do have a total terminal difficulty set. But, we are now hearing all of this word about another Ethereum fork, and that would be 3 Ethereums. As you guys know, Ethereum Classic never really took off on the initial fork, and it didn't end up going so well in the early days. Now, Ethereum Classic has recovered a lot, but any new fork would probably suffer, in my humble opinion, the same issues that Ethereum Classic did on the previous fork. A lot of investors, developers, and so on are going to stick with Ethereum. That is just the fact of the matter, and it's going to be interesting to see. One of the things that I did want to point out, because people always ask me, why Ergo? And here is why Ergo, just flat out, right? Ergo is the only ground up competitor to Ethereum that is proof of work. There is, of course, Ethereum Classic, but that's not ground up. That's a fork of Ethereum. And if we're talking about a ground up project that is proof of work that has all of the features and capabilities of Ethereum with additional features and capabilities, I might add, it's only Ergo. There is no other one. So from the proof of work standpoint, you need to be taking that into consideration as moving forward. Does that mean that there's not other good projects for proof of work? No, because obviously there are other things within cryptocurrency and blockchain and other technologies and things that you could be deploying that are beneficial. For example, all the work that Flux is doing with Web 3.0. And so there is, of course, other projects and are, of course, other projects. And then, of course, there's the question of what happens if there's failure on Ethereum after the merge. What's the easiest for devs to move to? Well, as you guys may know, a lot of that can come down to just adoption and so on, and adoption of a cryptocurrency into things like exchanges and wallet support and so on, and even compatibility with EVMs and such could force people, as far as devs, if there is something wrong with Ethereum, to move to Ethereum Classic. So there's all your arguments for all of the proof of work coins that you guys may or may not be interested in, and that is for them. I have arguments against each single one, including Ergo, but we won't get into the arguments against them because we would just end up sitting here all day debating, I think. Let's get into this because we need to figure this out. Miner Chandler Go repeats support for Ethereum fork post-merge. He told CoinDesk TV he wants to create a new proof-of-work blockchain to help miners. Ethereum miner Chandler Go is reiterating his push for Ethereum to undergo a hard fork once it becomes a proof-of-stake blockchain next month in a software update known as the merge. He told CoinDesk TV's First Mover program on Friday that he has helped organize miners to back his effort as a way to save them from having to shut down their business. This time, the fork is much more difficult because I need to organize a lot of people, miners, to join this fork, Go said. And here's the deal. Am I planning on it? Not financial advice. Am I planning on going with a fork of Ethereum? No, I wouldn't. In fact, like I said, I'm going to be much more inclined to support something completely away from the Ethereum ecosystem, whether that be Ergo, Flux, Caspa, anything else, right, at this point. So yes, he does have a difficult position here because also who takes control of this, right? Well, if we look at essentially the kind of path that this fork is already taking, there are basically three different people that would take control of this chain. And this is important because who is going to be in charge of the chain will have some effect on how successful it is. So number one, we have Bitmain and Antpool moving away. They're looking at Ethereum Classic. So they're out. We have their $10 million, donation or however that functions, funding for Ethereum Classic projects. That's important to note too, because that means you have that Bitmain in control and that influence over the Ethereum network. What does that mean for miners? That means that more than likely, well, it's Bitmain, it's Ethereum ASICs. It is probably going to be focused on ASICs. That is what we're looking at. When we look at this project in particular, a proof of work Ethereum, a third fork, or a second fork, a third Ethereum, what are we looking at there? Well, we're looking at two people. We're looking at Go here, and we're looking at Justin Sun, and that's the Polo Nex exchange. Neither of which have had, a successful time with what they've done, with Go obviously forking Ethereum Classic and organizing that. And then, of course, Justin Sun's propensity to scams is the best way I could put that. And these are not people that you necessarily want to put your trust in to manage a fork and manage a whole new chain, at least in my humble opinion. That's what I see when I look at it. Ethereum is making the move to a more energy efficient proof of stake method, maintaining its network and validating transactions from its current proof of work method around September 15th and 16th, according to the developers. Go has been pushing for a fork for several weeks. In July, he tweeted, "I fork Ethereum once, I will fork it again." While the network is expected to slash upwards of 99% of its energy consumption after becoming a proof of stake platform, Go argues that miners should be taken into account. A lot of people, miners, are suffering, he said. Some miners, however, may benefit from the merge, particularly Ethereum Classic miners, according to JP Morgan analysts, which we covered that article last week. And CoinDesk reported on Thursday that the software update will likely make more used mining rigs available. Go, who has supported the fork of Ethereum Classic in the past, said that he plans to hold the native token of the forked proof of work blockchain dubbed ETHW until the next bull market, which he estimates that will happen in the next 2 years. Overall, to me, ETHW sounds like a money grab. You want to be very careful surrounding it. If he's holding it till the next bull market, what is he saying already? That he plans to dump it in the next bull run. And I don't know necessarily that that's a bad plan. It's just not a sustainable one for miners. So if your initial statement is, well, I'm going to fork ETHW and then I'm going to hold the coin so I can dump it in the next bull run, you're already telling me that you don't really have plans on actually making this a usable, viable blockchain. You just have plans to make some money off of it. And that is where I see a bunch of red flags begin to come up. And we can see a similar sentiment from Justin Sons in their listing on the Polyonex, or I can never pronounce that exchange, but where you have a listing of ETHW, and its parity's not bad. I think it's like 70% of ETH right now, but it doesn't have any ties to a real blockchain, meaning any of your purchases are just recorded in that centralized exchange, and there's no proof and no way for you to send it out of that exchange. So there's no proof of ownership. So be very careful surrounding that. All right. And I highly doubt that ETHW will end up launching with a 70% price compared to ETH proof of stake, or how ETHP, ETHS, ETHS. Yeah. Anyways, now there is an interesting argument and article here between proof of work and proof of stake for investors. Now, we've been trying to get I have been trying to get a better idea of like how investors see things, because it's really interesting as they seem to have, first of all, an even lower level of knowledge surrounding blockchain than the average miner, for example. So they don't understand all of the intricacies surrounding it for the most part. But they do have the most capital, right? And their participation matters a lot. So understanding their point of view, I think, is extremely important. Now, this is an opinion piece from CoinDesk. And it says, if you know anything about crypto and also read the news, I'm sure you've read about crypto mining. And if you've read about crypto mining, you've read about how Bitcoin depends on proof of work, which is so terrible for the environment, and about how Ethereum is moving from proof of work to proof of stake soon, which is so much better for the environment. Which is better? In answering that, most proof of work versus proof of stake pieces either get too technical or are too obviously biased. From an investor perspective, you just want the facts and the trade-offs so that you can make an investment decision. And see, I feel like as an investor, you would want to actually understand it from a technical perspective, but I do get it, right? I mean, much of this world and even in the stock markets and so on has a lot less to do with what's technically going on and more about how investors feel surrounding some sort of project or entity or company or whatever it may be. I'm not, in blockchain, I think it does get down to needing to have a little bit more of a technical perspective surrounding this. So I disagree a little bit, but once again, I'm doing this to get the investors' perspective. So their perspective is, just a top-down, high-level trade-off of it. So herein lies the investor's definitive guide to proof of work and proof of stake. An actual book could be written about this. So a lot of the technical nuances will be papered over to avoid word count creep. But first, a quick detour that I promise is relevant. This might surprise you, but investing in software engineering aren't too different. Fundamentally, investing is about trade-offs, so is software engineering. In investing, you have a certain amount of capital and you allocate that certain amount of capital in a certain way. When you choose to invest in thing one, you can't also invest in that same capital into thing two. And in choosing to allocate to thing one over thing two, the allocator takes several things into account, like expected return, risk profile, or if investing in thing two would be a cause for termination because the boss doesn't like thing two for whatever reason. In software engineering, you have a product that has a particular behavior and structure. An engineer will design something that behaves a certain way and will make structural decisions for the code. These structural decisions determine how easy it would be to make adjustments down the road. Cryptocurrencies aim to operate their networks without the extensive use of third parties. To do that, network participants need a way to decide on what's what and come to a consensus. Enter the consensus mechanisms. There are many consensus mechanisms, but the two most important ones are proof of work and proof of stake. Between the two, there are trade-offs, but the most critical thing to know about consensus mechanisms is that they need resilience to ward off attackers of the network. So let's take a piecemeal approach of the investor's guide by first defending proof of work in the context of Bitcoin, and second, defending proof of stake in the context of Ethereum, and third, outlining some of the trade-offs. In defense of proof of work, there are so many awful comparisons people use to describe proof of work. Here's one. There's a lottery. To win the lottery, you need to buy the winning lottery ticket. To buy a lottery ticket, you need a computer that can do lottery ticket buying. The more computers you have, the more lottery tickets you can buy. And if your lottery ticket matches the winning number, you win. So the more computers you have, the more likely you are to win the lottery. Now, he says this is a bad definition, but this is exactly what Chia is, by the way, because what Chia is that you are basically printing bingo cards onto your hard drives in hopes that you print the winning bingo card. So in some cases, and now, yes, as far as a consensus mechanism, it's proof of storage, essentially, and there is that. But the trade-off with that, too, is that in a time when we are so dependent on big data, and data is so important, and the rising need for it, taking essentially hard drives and using them for a meaningless purpose, such as printing random bingo cards on them to win a block, doesn't seem the best move or necessarily green, in my opinion. All right, so that aside, though, in Bitcoin, which uses proof of work, miners, as the proof of work lottery ticket buyers are called, use application-specific computers to guess the number on the winning lottery ticket. Those computers have microchips that can do guessing and run on electricity. The only way to get the right number is to do the work. Proof of work has distinctive advantages and disadvantages. Proof of work is a resilient way to build distributed consensus and deter spam. Proof of work has been used in Bitcoin since it launched in 2009 to trustlessly run a decentralized, borderless, open payment network. Bitcoin's proof of work mechanism worked just as well when a Bitcoin was worth 6 cents as it did when it was worth $60,000. Bottom line, proof of work works, and it works really well. That said, proof of work consensus mechanisms are hardware intensive and rely on high demand microprocessors. As a result, investing in proof of work can take time if there are supply chain disruptions, as we've seen recently. Due to the need for consistent electricity and warehouse space, there are centralizing geographic choke points where mining tends to coalesce in places with adequate space and cheap electricity. So while miners may be distributed across the machines, they could all end up setting up shop in, say, the Chinese province of Sichuan. Proof of work does have a double-edged sword. Depending on your specific framework, it uses electricity. I'm not going to argue about whether Bitcoin is valiant use of electricity or is utilizing the right kind of electricity, but it certainly uses it. Yes, proof of work could monetize otherwise wasted electricity, stabilize power grids, and boost local economies, but Bitcoin mining has revitalized some otherwise obsolete fossil fuel electricity generation plants as well. This isn't in defense. It feels like, and this will be interesting to see how they write, but this is already feeling biased against it because this was supposed to be in defense of proof of work, and they're very poor arguments that actually go against proof of work for the most part. They kind of reiterate some of the points, though, that we make, like stabilizing power grids and, reducing waste of electricity, that sort of thing. But that was very odd. So in defense of proof of stake, there are some awful comparisons people use to describe proof of stake. Here's one of mine. There's a lottery, and to win the lottery, you need to purchase a lottery ticket. To be allowed to buy a lottery ticket, you must be chosen. To be chosen, you need to commit money to the lottery. The more money you commit, the more likely you are to be chosen. If you're chosen to buy a ticket, your ticket will automatically match the winning number and you win. So the more money you have committed, the more likely you are to win the lottery. In Ethereum, which will eventually use proof of stake, validators, as the proof of stake lottery ticket buyers are called, are chosen randomly to win lottery based on the amount of capital they have staked. The way to get chosen more often is to stake more capital. Yes, the way to get chosen more often is to stake more capital. There are ways in proof of work that do increase your odds. I'm not sure outside of the lottery ticket description that they're using here, such as reducing latency, increasing, network performance, all that sort of stuff, building out your own node infrastructure and so on. I'm not so sure that there is a way to do that with proof of stake necessarily. But I guess technically with Ethereum, building the consensus and execution layers on the same machine, or at least within the same network, could probably provide some advantages there. Proof of stake has advantages and disadvantages. It is an effective means to build distributed consensus. While nothing is battle tested as proof of work, there are cryptocurrencies that have been using proof of stake successfully for years. In the world of Ethereum specifically, it is very expensive to become a validator. And here's the thing about this first one, right? There are, cryptocurrencies that have been using proof of stake for years. That is true, but not to the level of use that Ethereum has had, right? And so this will be kind of where the rubber meets the road when we talk about proof of stake versus proof of work, because the rubber is about to meet the road, and all of the use cases that Ethereum has and the amount of transactions that are on it will be the first time we see something like this to this scale on proof of stake. So that's going to be a big question. In the world of Ethereum specifically, it is very expensive to become a validator. To become a validator and participate in the lottery, you need to commit 32 ETH, about $60,000. Granted, there is a mechanism in which you could commit less ETH to a pool of capital that is then staked, but that isn't the same thing. The high starting cost could result in a rich blockchain with only wealthy capital holders participating and validating. Interesting. He keeps saying, here's in defense of, and then really it's flipped. This is a good argument, against a proof of stake, essentially. Proof of stake does have a double-edged sword. Depending on your specific framework, it uses capital. In a way, this is advantageous because anyone, anywhere with enough money can become a validator. There isn't the same geographical centralization risk as there is with proof of work. Okay, although there may be one given wealth inequality across the globe. That said, because proof of stake only requires capital, the barrier to entry can be lower. It doesn't require just capital, though. And that's like the confusing part that I think a lot of people run into. So from the infrastructure standpoint, it does require basically a PC, a virtual machine in most cases, usually run in on a virtual private server. And we'll talk about the centralization risks there geographically as well. But it requires that. And it not only does it require it, but it requires it to run 24/7 with backups, which means that you need to have basically three pieces, right? You're going to have a backup server, a server running the backup server, running the main thing, and then some sort of failover server sitting there to take it over whenever it fails over, if the initial server fails over. So you basically have three different pieces. It'd be like if you had to try to set up redundancy for proof of work, which is technically impossible and one of the big problems with hosting GPUs, or GPU mining, by the way. But there is all of that problem. And where are we seeing a majority of the validator nodes being built? Well, we're seeing being built in AWS, which is controlled by Amazon. So now not only do you have a potential geographical restriction, not as much with somebody as large as AWS, right? But you have a corporation centralization issue, right? Where basically all of the power everything to power the blockchain and provide consensus is all being run by a single entity. Sure, maybe not completely like geographical restrictions, but essentially a single entity, a single company. It's corporatized, right? And at any point, like we've seen with centralized, data centers and so on, they could decide that they don't want that sort of thing on their network and just take it off. Case in point would be something like Parler, where they didn't agree with Parler or what it was doing, so they just took it down themselves, right? And this is something that could be done and could be a huge risk to proof of stake coins. If we merge, for example, on Ethereum, and the proof of stake is going good, but then the SEC decides, for example, that it's a security, and then they want to find an avenue to shut it down. Well, they could just basically petition AWS and Google and Microsoft to stop all services for blockchain, specifically Ethereum, if they wanted to. And then at that point, you lose all of those nodes. If those nodes don't have their keys backed up, then dear Lord, I cry for them. But hopefully they do and they can spin them up. But that means that they all need to start spinning up, well, their own server infrastructure. And to be frank, it's a lot easier for me to teach you guys essentially, and I can teach you guys server infrastructure too. In fact, I have a lot of plans to do that, but it's a lot easier to teach someone to build a mining rig or mine from their gaming PC than it is to teach them to build up server infrastructure with high availability, failover, basically multiple internet connections. So you have internet connection failovers and all of that, battery backups and so on. And if you do get to a point to where, all of these big and rich investors, this rich blockchain just gets shut off of AWS, more than likely, they're probably just going to dump the ETH at that point, recover their wallet and get rid of it. I just don't think that it is necessarily true that you have a more decentralized coin at the end of the day, and that's the reason why. As mentioned earlier, this could take up an entire book. The following trade-offs between proof of stake and proof of work are not exhaustive. It is easier to attack proof of stake network because proof of work is more resilient. Stealing some thoughts from Andreas Antonopoulos, all it takes to attack a proof of work network is electricity and hardware brought together at the right time, at the right place, with the right incentives. And logistically, this is becoming harder and harder to pull off. However, with this kind of move off of Ethereum from proof of work to proof of stake, I think we will see this threat come to fruition. And that's because a lot of the other networks are significantly smaller that remain proof of work for GPU mining. And a majority of, the GPU hash rate is currently on Ethereum, meaning that what you could end up in a position of is that all the miners move to NiceHash, which then just basically opens up an attack vector on every single small cap proof of work GPU mineable coin in existence. And this could be really, really bad unless they have solved these things in the past. Now, kudos to Ethereum Classic because they were attacked a ton because it was the easiest one to attack because of how close it is in comparison to Ethereum, that they started putting in, basically work into preventing this. So they probably have a pretty good standing against it. Plus all of the investment from Bitmain means that they will have all of the ASICs to help secure the network. Ethereum Classic's going to probably be good from the security standpoint. The rest of them, not so much though, when this starts to happen. With proof of stake, all it takes is money. To the credit of Ethereum, under proof of stake, it will still take a lot of money to attract or attack the network, but it requires less coordination. That said, proof of stake is theoretically more accessible because it only requires capital. Once again, it doesn't, okay? But that's okay. Granted, it can be a lot if you're looking at Ethereum around $60,000, but the coordination mentioned in the previous paragraph can be a barrier to entry that doesn't exist in proof of stake. In a similar vein, proof of stake is more mobile than proof of work. Given the electricity draw needed for proof of work, a government can figure out where miners are operating and shut down individual locations. However, this isn't as big of a problem if we look at something like Monero. So once again, it depends on the scale and the incentive. Like right now, because proof of work, you're incentivized to build a bunch more rigs and so on. That does mean you do get a concentration of power on the network. Now, governments can shut them down, but then I think Bitcoin's fine because you just end up having less, you have an auto-adjusted difficulty that takes into account that problem. Moving a proof of work operation that's been shut down to a new location takes a lot of work. We saw this happen when China banned Bitcoin mining last year, which led to a drop in network activity that eventually recovered, although it took some time. It really didn't take much time. What was it, 20%, 20 to 30%, and then it recovered within about a month to 3 months? Moving a proof of stake operation would be trivial in comparison. Now, I do think that is true. Last one I'll touch on, but not expand on because I don't truly believe it should matter, is that proof of stake doesn't use electricity and proof of work does. So if you're a single issue investor investment in proof of work might not even be a consideration for you. There are merits to proof of work, and I have spent years defending Bitcoin mining privately and professionally, but in the end, I'm not here to tell you how to think or what to do. Now, that statement's interesting because there is the narrative that it uses, doesn't use electricity, but it does use electricity, right? And it does create more processing waste in general, once again, because of your incentive to basically have backups and failovers in place, meaning you just have additional power to run that node that is not doing anything. Still going to be less than mining, right? But you do have some electricity that goes into it. So that pretty much covers their opinion from the investor standpoint. It seems like obviously the big one is the power thing. And then from there, it's the barrier to entry. And I do think that from the investment standpoint, that is the biggest issue. It is the barrier to entry, a barrier to entry to actually run a full stake of Ethereum that you control the keys to is going to be around $60,000 as of right now. Whereas with mining, you could buy a GPU as cheap as $150 and start to basically generate some revenue. So that does mean from an investment standpoint, I think proof of work versus proof of stake is better, but also the investors are looking at just buying the coin, not necessarily doing the validation, whether that be proof of work or proof of stake. So then you come down to basically what they think looks more appealing. And the narrative that, proof of stake is more green is a very strong narrative that I think influences a lot of retail investors. And that is proving out to be true as we start to see, of course, the price of Ethereum continue to go up with reports of its move to proof of stake and the merge coming in September. So there you go. Let's get into mining profitability right after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. All right, so to address one thing that I think a lot of people maybe want to hear, like I think T.S. Eliot was saying a legitimate reason for Ethereum Classic to pump instead of just hopium. Here's the legitimate reason. First of all, what we have is essentially a bunch of ASIC miners that are on the network that are going to move. And just like Bitcoin, essentially what you end up with is a position where when they start to validate the network and secure the network, they are spending money in power to secure that network. And because the minting process means new mintable coins are going to the miners, miners will be a lot less likely to sell that at a loss. Now, of course, right now we have the bear market and miners are basically faced with a ton of selling pressure, so that could influence it. But in general, you basically have the network effect times, probably like what, 800% or something like that. It's absolute insanity. That 800% of whatever the previous halving of Bitcoin was that influenced the previous bull run. So there is specifically a reason why Ethereum Classic would go up in price purely based on ASIC mining and the amount of ASIC miners that will be moved over to Ethereum Classic and the cost it will take to actually produce those new Ethereum Classic coins. Okay, mining profitability though for the day on what to mine. I do not have it for myself. We'll be getting into that later this week. I'll be talking about it. But with an RTX 3090 with corrected ZIL hash and KPOW, ProgPoW, and Firo proof of work hash rates at 10 cents a kilowatt hour. Cero comes in first. Be careful with this one at $3.40 a day in revenue and $2.61 a day in profit after power. Ethereum at $3.26 a day in revenue and $2.49 a day after power. Ravencoin $3.16 a day in revenue and $2.36 a day after power. Neox at $2.88 a day in revenue and $2.08 a day after power. Firo proof of work $2.87 a day in revenue and $2.12 a day after power. Then we have Flux at $2.70 a day in revenue and $2.01 a day after power, and Ethereum Classic at $2.70 a day in revenue and $1.93 a day after power. We also have down here Ergo kind of falling down to $2.15 a day in revenue and $1.53 a day after power. Taking a look at mining pool stats, let's go ahead and hop into it and see if we've seen any big network changes. We are still around 230 exahash a second on Bitcoin, so no significant changes. If we take a look at Ethereum, we are looking at 960 terahash a second, so no significant changes. If we take a look at Ethereum Classic, we are at 33 terahash a second, so no significant changes, but it has gone up 6%, almost 7% in the past 7 days. If we take a look at Flux, let's hop into that. We are looking at a price increase of 53% over the past 7 days. It did break $1 this weekend, but we saw, along with the price increase, an increase in hash rate to 1.5 mega solutions a second. So right now, Flux is pretty much at its cap. What do I mean by that? Well, it went up about 50% in price, but it also went up about 50% in hash rate from 1 mega solution last week to 1.5 mega solutions this week. So that does mean it's near its essentially network capability unless it increases in price further. Let's take a look at Ravencoin. Ravencoin is still at 2.33 terahash a second. And then let's look at Ergo. And Ergo is at 11.25 terahash a second. It's still up over $3 right now, which is a 42% increase. We got that delayed increase in difficulty now coming in. So your difficulty is really at the 13.59 terahash a second. And that is one issue that I think Ergo really kind of sets itself apart on, is it's not going to be as easy to scale that kind of difficulty counter with the amount of profitability that you can get. So as you can see, we're at about 12% increase in hash rate with a 42% increase in price. That should mean that we could maintain a higher hash rate. But I'm not sure that that is proving out to be true because, unfortunately, the difficulty on the network seems to always have this weird delay that happens. Anyways, let's get into mining pool profitability on Ethereum. For the past 90 days, ZET in first, Ether mine in second, Crazy Pool in third. For the last 60 days, ZET in first, F2 Pool in second, Nano Pool in third. For the last 30 days, ZET in first, Nano Pool in second, F2 Pool in third. For the last 21 days, ZET in first, Nano Pool in second, F2 Pool in third. For the last 14 days, ZET in first, Nano Pool in second, Flex Pool in third. For the last 7 days, ZET in first, Nano Pool in second, Flex Pool in third. For the last 3 days, we have ZET in first, Nano Pool in second, Crazy Pool in third. And for the last day, we have Nano Pool in first, F2 Pool in second, and 2 miners actually coming up for the first time in a while into third for today. ASIC miner profitability, the E9 is still most profitable at $67 a day on 2 miners. And then if we scroll down, we got the Antminer L7 now beating out the KD6 again. It's still sticking around that $20 mark. It's $22 to $23 a day, while the KD6 drops down under $20 a day. On Friday, it was technically more profitable, but it's at $17.57 a day. If we scroll down, the KD5 is at $11 a day, and then the S19 Pro is around $567 a day. I want to thank everybody that is here and supports the channel every day. And I definitely want to thank everybody that supports me over on Locals. You can become a member on Locals for free. So if you want to stay up to date with the channel and when we're live and what's going on, definitely head on over to sonofatech.locals.com and get signed up. We're almost at our 800 mark, which is the goal for memberships. If you want to support, you can support, but you don't have to support, and that is $5 a month. And then I think there's some discounts for annual, like $50 or something like that. And that just goes directly to supporting the channel and getting more content out for you guys. I'm a one-man show, so a lot of this takes me a lot more time than I would like to. There are a lot of ideas and a lot of things that are in the works, but sometimes it just is hard to get everything done, especially when I run into technical issues. Right now, the number one technical issue that I am dealing with is specifically on some nodes, and the Ergo node is having some issues actually with the stratum portion of it. So it's basically having high ping. So I got to go deal with that today. Otherwise, I would do a Q&A because we're going to skip the Q&A today. Remember, super chats are never required, always appreciated, first to be answered, but today we're not going to be answering anything. Super chats or super stickers help boost the algorithm. So if you guys want to do that, that's much appreciated. But like I said, today I got to get over to jiu-jitsu because I won't miss a day. I try not to miss any days of jiu-jitsu. It's already 11:15, so I got to get out there by noon. I got to get all my stuff together. So I want to thank everybody for stopping by today. Go check out the second channel. It is now monetized, so I'm super excited about that. And more content will be coming out over there as well. Be sure to hit the like, comment, subscribe, and notification bells, and keep calm and mine on. I think overall, guys, everything's looking pretty good in the crypto markets. It's definitely a nice little breeze that came through. We'll see how long that breeze lasts. I'll see you next Tuesday.